Sounds good.
Alrighty. Well, thank you everyone for joining today. Really excited to have you. This is I think the fourth or fifth out of our Outlook webinar series. I'm Miles, and just to get everybody started, you will all be muted throughout the presentation until the end. We'll ask you to type your questions for the Q&A afterwards. And I will go ahead and send this off to Ian, who will introduce Sprint.
Thanks, Miles. Welcome everybody who's online for this week's webinar. My name's Ian Sheldon. I'm a faculty member in the department, and my pleasure to introduce my longtime colleague, Brent Sohngen, who's going to talk about energy security and the environment. And just to re-emphasize what Miles said, if you have any questions, please put them in the chat room or the Q&A box in Zoom, and we'll save those questions for later at the end of the seminar. So Brent, the floor is yours.
Great. Thanks a lot, Ian. Thanks a lot, Miles. It's a pleasure to be here and be with everybody, and appreciate your all attending. It's going to be kind of a whirlwind today. I'm going to run through a bunch of slides, so I apologize for throwing so much information at you at a relatively rapid pace. But the energy sort of area is obviously blowing up, exploding, and there are just a ton of things going on, especially as it interacts with the environment. So I had a tough time sort of narrowing down exactly what to talk about. And every time I sort of focused in on a specific thing, other things came up in my mind. So I'm trying to hit a lot of things here. But hopefully it's useful to you. And indeed, if there are any questions or follow-ups you'd like to have afterwards, for sure, just go ahead and send me an email. Be happy to chat further or provide you with some extra data. So what are we going to talk about? We'll just talk about some general trends in the global and U.S. energy sectors. I'll talk about gasoline, diesel, and natural gas. I mean, we want to talk about the environment, but you can't go far into the environment without talking about these really important fuels for our economies. Then talk about renewables, especially here in Ohio, and a bit about carbon. This sort of carbon market has grown in the last few years, and really the last 20 years, and is becoming a more and more important part of the energy sector. Okay, so moving right into it, let's just talk about some global energy trends to start out with. Just thought I'd start with some general statistics on what's happening in the global market for energy and energy consumption. If you look on the right, you see energy consumption by fuel. Few things stand out there. As in the last decade and a half, maybe 20 years since the turn of the century, renewables have really grown a lot. They're the fastest growing sector of energy production globally, in the US, in China, and many other countries as well. You can see also that oil, natural gas have also risen. Hydro has risen. Nuclear has fallen a little bit. Coal in the last few years has fallen, but seen a little bit of an uptake in the last year or so. So we've seen some continued growth in the energy sector globally, sort of led by what's happening in the renewable sector. Total energy consumption is up 1.3% per year over the last decade. Global expansion in coal did slow, but we're seeing a bit of an uptake, as we just talked about. Focusing a bit more on the US, we see some even bigger fluctuations over there on the right-hand side in terms of the energy sector and production in the US. So the blue line is the oil sector in the US, and oil production declined from the 1960s through the early 2000s, and then rose rapidly in the early 2000s through the present as we exploited these shale deposits we have in the US. Same thing with natural gas. Natural gas was fairly stable for a number of years, starting in the 1960s, but then started to increase in production in the US as well, in large measure because of shale gas production. Coal, on the other hand, has fallen. Even though we have an ample supply of coal, the amount of coal that we use has fallen pretty dramatically in the last 20 years, in large measure because we've substituted natural gas for coal in the production of electricity. Nuclear power has been fairly stable. It's been declining in recent years as some plants have closed down, and in the US, as in the rest of the world, we've seen a big increase in renewables. On the left-hand side, as we start to think about what the total numbers are in terms of percentages for energy consumption, oil is about 38% of our total energy consumption, natural gas 32%, coal down to 10 or 11%, nuclear 8%, hydro 3%, renewables 11%. So total renewable sector is about 11% of consumption in the US, driven heavily by what's happening in the Western US, in particular in California, but in other states as well. A question I often get is whether the US is energy independent. And when we add together all sources of energy, and we look at this left-hand graph, we see that when we add together all sources of energy, we are indeed energy independent and have been for a couple of years, or actually since 2019. So this gray line on the left-hand side is our production of energy in the US since the 1960s, and the black line is our consumption of energy in the US. And we can see that consumption has stabilized since the, say, about 2005, 2007, and fallen a bit in terms of total energy, while our production has increased largely because, as we talked about, shale gas and shale oil exploitation of that resource has grown dramatically in the last 20 years. We're also energy independent, or were energy independent in 2019 in the oil sector. Kind of surprising in the US, right? We've spent many years worrying, obsessing perhaps about whether or not we could be energy independent in the oil sector. And we saw in the 1990s and the early 2000s, we saw our energy independence potentially disappearing, right? As our oil production was declining and our growth in energy consumption, oil consumption was increasing. But starting in about 2005, 2006, oil consumption started to decline in the US and oil production increased dramatically. So that we became energy independent in 2019. We're not so much anymore, although as of the last year, we're almost back to the same levels of oil production we had in 2019. On natural gas, we're more than energy independent. We're actually producing a bit more natural gas now than we're consuming, and exporting some of that to other parts of the world. So as a whole, the US is fairly energy independent. I guess you have to ask, what's that actually get us? Well, it gets us some security. That's a nice thing to have, but it really doesn't prevent us from experiencing price shocks, right? The big price shock that we experienced last year when Russia invaded the Ukraine and created havoc in both oil and natural gas markets, we experienced that pretty dramatically here in the US, just like other parts of the world. Perhaps not as bad as the Europeans did, but nonetheless, we experienced big increases in prices because these markets are really heavily tied together and they're pretty closely linked together through trade. Energy demand and supply also are really inelastically demanded and supplied, which means anytime there's even just a modest shock, we can see really big movements in prices for those marketed goods. So we might ask the question, will increased reliance on renewable energy limit some of these price shocks in the future? And that's not going to happen for a while until we get to really low levels of non-renewable sources like oil and gas. We're going to continue to see pretty big price shocks anytime even modest changes in the market happen. Modest reductions in supply, a hurricane here or there, a war here or there, et cetera, will have big effects on prices. And that'll continue to happen for the long term, even though renewable energy will continue to put downward pressure on prices for most of the resources that we have out there. Okay, so let's talk a bit more explicitly about gasoline and diesel markets and think about where we're headed with those. So on the right-hand side, I put two things on each of these graphs so you can see the connection. So the top graph is the real gasoline price from 1990 through about 2 weeks ago. That's the black line on the top. So that's a weekly price. And then I plotted in the gray line below that, just the oil price over the same time period. Both of those measures are in real terms, so they're adjusted for inflation. And so what we can see is that over this period from 1990 to the present, when we had that big price shock for oil and for gasoline in last year, about this time and a little earlier than this time last year, we were at really some of the highest prices we had seen for the last 30 or so years, right? In terms of real terms, we were paying significantly high prices for gasoline and for diesel. It's the same thing on the bottom graph. So we were paying really high prices in relative terms and relative to what we had been paying for the last 30 to 40 years. So it's a pretty big price shock. Of course, what we've all seen, much to our happiness, is that those prices have declined recently. So you can see on this graph that oil and gasoline and oil and diesel prices sort of fluctuate together as we would expect. The difference between those prices is driven by the margin of actually producing them or refining the oil into gasoline, etc. Excuse me. So we've seen these prices sort of come down recently. And if you start to ask the question, well, what's going to happen in the next 6 to 12 months? Well, a big thing and a big concern people have is these OPEC production cuts. They kind of surprised the market about a month ago when OPEC made a further cut, an unexpected cut in their oil production, or proposed cut, and they implemented that, or supposedly implemented that, as of May 1. That pushed prices up a little bit, but as of today, prices have actually gone back down. They're back, I think, around $70 a barrel, $72 a barrel, something like that in terms of the West Texas price. So even though OPEC has made production cuts, what they're doing with these production cuts is they're trying to sort of keep up with their expectation on demand. So OPEC, if you will, is telling us what they think is going to happen to the demand for oil in the next 6 to 12 months and perhaps the next 2 years. And basically what OPEC is telling us is they think the world's heading for a recession. So they're implementing some production cuts today in order to try to get ahead of that potential recession and the potential decline in demand for oil that will come with that recession. So OPEC is kind of telling us what their demand projection is, and we're also seeing that from a lot of other demand projections when we look at the IMF, the U.S. Federal Reserve, et cetera, et cetera. Demand projections are sort of slowing down now. People are looking forward to some sort of a recession down the road and some potential pullback in terms of demand in the economy. We could see some increases in prices a bit this summer as summer travel demand happens, potentially hurricanes affect production of gasoline in the Gulf of Mexico region, et cetera, et cetera. A longer term concern that could drive prices up over the longer term is that there is concern that the shale boom in the US, in particular for oil, is starting to slow. We're starting to see and hear lots more of the folks who really focus on that industry in Texas, which is where most of the oil with fracking is produced in the Permian Basin, that's in Western Texas. There's lots more discussion that many of those fracked oil wells their production is starting to sort of stabilize. It's harder to get increases in that production. It's more costly to get increases in that production. And so there is worry that the shale boom is starting to slow down in the US. As we look in the future, the big question we have is where is demand headed and what might happen with some supply gains that could happen from Venezuela and what's going to happen in the shale boom. I don't have any answers for those, but those are questions that are out there. One comment on diesel. We did notice, and lots of people noticed, that diesel prices went up a lot more in percentage terms than gasoline prices when oil prices fluctuated. You can kind of see it here. You can kind of see in this graph that there's a bit more of a dissonance, if you will, between diesel prices and oil prices. And so diesel prices tend to fluctuate a bit more when oil prices go up or down. And this seems to have a lot to do with that particular market, right? With the particular market for diesel and the fact that there is a significant demand for that amongst a number of different sectors who don't have a lot of other substitutes. For gasoline, there seem to be a few more substitutes, especially emerging now with electric cars and other kinds of transportation alternatives. However, with diesel, trucking, et cetera, it's a lot more difficult to find substitutes for that. So it makes that particular commodity, diesel, a bit more susceptible to price shocks when we have oil shocks. All right, in the next 6 to 12 months, my projection is oil prices are going to be fairly stable and could actually be declining. We could see prices go down in the $65 per barrel range. They could go up to $85. I'm a typical economist. On the one hand, they could go this way. On the other hand, they could go that way. My bet is probably on the low side is that they'll be in the $65 to $75 range. The $65 to $85 in terms of my looking at different projections from S&P, EIA, Bloomberg, et cetera. This is kind of the range I've seen. A number of the prognosticators out there suggest that oil is going to go in the next 6 to 12 months. And that puts gasoline prices kind of in this range and diesel prices in this range. So that's kind of what we're looking at in the next 6 to 12 months for oil prices. The bigger question, see if I can get there we go, get both of these pictures up there, is the long term. Historically, there's been a lot of discussion about peak oil, right? And peak oil has focused on the idea that we're going to run out of this stuff. And in fact, in the US, we did run out of this stuff. So this is a longer term look at oil production in the US from 1900 to the present. And at one point, we thought our peak oil production had happened in the early 1970s, 1971 to be specific. And then we saw a big decline in oil production in the US for a number of years until the fracking boom really took hold in the early 2000s. So there was lots of worry then, right? That's when the limits to growth happened. The Meadows and Meadows report, right? Lots of people were worrying about sort of what the future was going to look like as we ran out of oil, this really important resource. In the early 2000s, we were less worried about that as we sort of entered into the shale boom. But now we're sort of back there again, and we're asking the question, is this shale boom over? Are we starting to see those shale wells sort of mature and not be able to produce as much oil, or take a lot more money to produce oil? So if we don't see significant increases in oil prices, we're not going to be able to see big increases in shale oil production. So big questions out there about whether or not we will start to see this sort of peak oil in terms of production from shale in the US. So right around this level of 1.2 million barrels per day. All right, that's the history. The future is looking more at this question of peak demand. That is, and this might even be a more important long-term question. In my mind, actually is a bigger important question. Is actually more important than this question on the supply side. Is that have we reached peak demand in our use of oil? That is our use of petroleum products. And in the US, it looks like we have. Our peak in the US seems to have been in 2007. That's when we experienced peak demand for oil products in the US. And since then, they declined for a while. And even in those periods where they grew pretty substantially in the early 2000s, they didn't grow back to the same level, right? So it seems to me that we've actually reached this area where we may have hit sort of peak demand for this really important sort of oil resource. And that's a question out there. Have we hit peak demand? If you think about it in the long run, that may be more important than peak oil from a supply side. Because if people's expectation is that they're not going to be driving around in oil-propelled cars or using something besides diesel, traditional diesel, using biodiesel or renewable diesel instead, then we might actually start seeing some reductions here, and that actually creates a whole different dynamic in the market going forward. Okay, so peak demand, what is this peak demand? So it wasn't just the US where demand peaked in, we get these slides to forward, there we go. It wasn't just the US where demand for oil peaked. It was actually in the entire rich world where demand, and this is the OECD, was the sort of the richest countries in the world, the richest 30 or so countries in the world. Their consumption of oil peaked in 2005 and has been on the decline, a pretty substantial decline ever since. Now, the other parts of the world, the rest of the world where, sort of the developing countries have seen continued increases in demand for oil, but there's some question about whether or not some of that demand has peaked in those countries as well. That's an open question. I'm not ready to sort of give my prediction on whether or not we peaked in those other countries yet, but it does seem clear that in the developed countries, the US, Europe, Australia, Japan, et cetera, South Korea, we've probably seen the peak in our oil consumption, and that's kind of heading down. Why? Why have we seen a peak in those countries? Well, fuel efficiency has been rising pretty dramatically. In the US, all-car fuel efficiency has been going up pretty substantially in the early 2000s over a period where we saw increased prices for oil. We also saw increased efficiency of the cars. We've seen an increase in the electric car market. So this is electric car registrations around the world. Those have been increasing pretty rapidly, shifting the consumption for driving from oil to electricity. In the last few years, we've seen a shift, and a pretty substantial shift in work habits. In many parts of the world, we've seen increased urbanization, and urbanized people who live in urban areas use far less gasoline on a per capita basis than folks who live in suburban or even rural areas. So there's lots of factors that are driving this sort of peak demand for oil and will continue to drive it. These don't seem to be things that are going to disappear in the near term. These seem to be factors that are probably going to continue on for some time. Why do I say that? Well, what's driving these shifts? One thing is consumer preferences. We do see increasing consumer preferences for cars with more fuel efficiency. And you know what? That stands for trucks and SUVs as well. So even though the SUV market has expanded and exploded, the big part of that market that's exploded hasn't, trucks has gone pretty big. I got to admit, trucks have really increased, right? And I think every state now in the US has a majority of cars or personal automobiles as trucks now. That is more than 50% of the automobiles in every state. I think every state now are trucks. So trucks are really important. But with SUVs, we've seen huge increase in emergence and increase in the number of the smaller, the mid-size SUVs. And these get far better gas mileage than the bigger SUVs. And furthermore, every time you buy a new one of those, it gets better gas mileage than you got before. So even though there is some preference, at least in the US, for some of these larger cars are doing far better in terms of gas mileage as well, just like the smaller cars are. So, consumer preferences are heading towards trying to figure out ways to minimize your own exposure to high gasoline prices. Policies are also having a big effect. At the federal level, we have fuel efficiency standards. The state of California has fuel efficiency standards. They have a low carbon fuel standard, and they have these new rules coming into place in the next 5 to 10 years, which will limit the number of internal combustion engines that can be sold. Those same kinds of rules are coming into place in Europe. China, there's a big movement towards electric cars, driven by subsidies and some regulations. So these things don't look like they're going to disappear anytime soon. So these shifts, these factors, fuel efficiency, electric cars, shift in work, urbanization, all these things, they're going to continue to drive this oil consumption pattern and probably drive the oil consumption pattern down rather than up, especially in the developed world, but potentially in the long run in the developing world as well. And a lot of that is because of these sort of underlying factors in consumer preferences and policies. In the long run, this means that oil markets are going to have real trouble maintaining a long-term sustained upward price pressure. So that's a good thing, right? That's actually a really good thing for the environment, if you think about it. So if you're someone who's worried about the environment, the good part of that is that means that these big projects, really big projects to extract oil from, places like the Arctic or really or even Alaska, et cetera, are going to become economically less tenable to manage. If price pressure, if we're going to see prices, in the early 2000s, we saw prices getting well above $100 per barrel. If it becomes harder for prices to get above that level, then we're have a lot less likelihood that these big projects in places that are kind of far off actually get undertaken, at least until some massive new technologies come along to help those places out. It's also a threat to OPEC, if you think about it. OPEC traditionally does what? They traditionally constrict production in order to try to influence prices. But if they have a hard time influencing prices, and you have to think about it, there's competition, right? There's emerging competition between these electric cars and these gasoline cars that get fantastic gas mileage, right? So if OPEC is trying to push prices up, they ultimately might really have an effect on their market in the long run by driving people over to more electric cars. And especially as people start to get electric cars and gasoline cars that have 2 cars or 3 cars or 4 cars in their driveway, they already do. Why not throw an electric car in there, right? They're going to start to choose the electric car more often if OPEC is pushing prices up. So some interesting things here with this peak demand that add some new pressures to the future and make it a hard time for prices to really go up and make it a hard time for us to engage in these really difficult to extract oil, to go in and try to extract oil from these really difficult to get at places. And they also are a threat to OPEC. So there's some interesting things emerging in the future with this peak demand. Let's talk about natural gas for a second. In the US, all uses of natural gas have grown since 2001. Electricity consumption has increased by 72%, industrial consumption by 15%, residential 19%, and commercial 22%. Most of this has been the switch from natural gas to coal, right? Or from coal to natural gas. So massive switch in our electricity production where we're using a lot less coal and a lot more natural gas. Why is it? Well, this has been driven by what's happened here in the eastern US, largely by this massive increase in shale gas exploration and use of the shale gas in the Marcellus region, or the Appalachian region as we call it now, which is western Pennsylvania, West Virginia, eastern Ohio, and upstate New York. Huge increase. This green area in this figure on the right, where you can see the massive growth in natural gas production, it's all basically occurred right here in the sort of eastern region. So pretty fantastic increase in natural gas, which has arguably had really good environmental benefits for the US as we switched from coal production and electricity to natural gas production. So as this expansion of natural gas happened, we saw natural gas prices really moderate in the US, and we saw really low natural gas prices. So despite the fact, our previous experience, if anyone remembers way back in California, when we got when Schwarzenegger won the governorship, it was in a recall vote, right? When the previous governor, Gray Davis, got recalled because natural gas prices spiked and it created all kinds of problems in the electric markets in California. Lots of worry after that about, wow, should the rest of the country switch over to natural gas? Well, then we had the shale gas revolution. We were able to switch a massive amount of coal to natural gas and to keep prices relatively modest, right? Relatively low until recently, until last year when the concerns and the Russians invaded Ukraine, that drove up natural gas prices pretty substantially. But even then, in real terms, they never got to the same level as they were way back in the early 2000s. So natural gas prices, have been pretty low. They did spike last year, but they come right back down. Most recently, as of yesterday, I didn't look this morning, prices were at about 221 per million BTUs. So, we've really seen some big swings here, bigger swings than we've seen in the last decade and a half. Is this something we're likely to see in the future and continue with natural gas? I actually think that's probably a bigger probability in the future, that we're going to go back to more period like we saw in the late 1990s and early 2000s, where we had big fluctuations in natural gas prices. We're probably going to see that in the future. And the reason for that is because we have these big spreads and we have these export markets that are becoming more available for us in the US. So last year when Russia invaded Ukraine, we saw this big increase in natural gas prices in Europe, especially huge increase. So they're paying up to $70 per million BTUs in Europe, which is far higher than they have been paying before. While we were paying, even though we're paying higher prices, nothing near that in terms of prices here in the US. So we see this big sort of difference in prices. And the reason for that is because it's really difficult to move natural gas, right? So the Europeans cut themselves off from Russia. Actually, the Russians cut off the supply of natural gas into Europe. And the Europeans had to get their natural gas from wherever they could. It's much more difficult to ship natural gas by boats than it is by pipeline. So we saw this huge price spike. However, anytime you see a big price spike, an arbitrage opportunity like this, that's an opportunity for a new investor to come in and try to fix the problem. And sure enough, that's what the US has tried to do, as we've seen these huge differences in prices where we have low prices, someone else has high prices. So there's been a huge increase in capacity in the US to try to export natural gas via liquefied form. So these LNG export terminals have been sort of growing and increasing. So our capacity has increased pretty substantially in the US. And that's probably going to continue to happen, at least as long as our natural gas prices remain relatively low and modest compared to some other parts of the world. So LNG capacity and export capacity is going to continue to grow probably into the future. Okay, so now here's an interesting issue, right? That this high natural gas price has driven up fertilizer prices for lots of farmers, right? So fertilizer prices more than doubled last year. They've softened since as natural gas prices have come down. So the US has become a really big producer of ammonia in the last 10 years or so, as the US has experienced these relatively low and modest natural gas prices compared to the rest of the world. The US has taken advantage of that to produce more of its own ammonia. All right, so the interesting question about ammonia has a lot to do with its environmental properties, right? So ammonia is an interesting fuel because it's not so much a fuel, but it's maybe a transport opportunity for hydrogen. So ammonia has hydrogen in it. Hydrogen can be used to create fuel cells, which can be used to propel cars with electric engines, et cetera, et cetera. Ammonia potentially can just be burned itself in an internal combustion engine. That might be a technology that's coming down the road. So hydrogen has some real potential here as a renewable energy source. And ammonia is the way to potentially get that renewable energy source and to make that renewable energy source more easy to transport. So H2 can be stored and transported fairly easily as ammonia. And we can make ammonia in a couple ways that make it almost a carbon-free energy source, right? That make H2 almost a carbon-free energy source. So blue ammonia is ammonia that's produced via the traditional method. So it's the same methods we use to make fertilizer. But then we can actually capture the carbon from that process and store it if that ammonia is made in a place that's close to a place where we have geological storage potential for that. That's called blue ammonia. And we're seeing an emerging market for that, where companies are looking for ammonia. In particular, they're looking for the hydrogen associated with ammonia in order to make a renewable fuel. And that fuel can potentially be made as with the carbon capture storage that keeps that carbon from the production of ammonia out of the atmosphere. Green ammonia is another alternative that's produced using electrolysis and water and renewable energy. So maybe you set up a huge solar farm and use that to then produce ammonia and then take the ammonia and move the ammonia from one place. Why are people doing this? It seems kind of crazy, right? Why are we doing this? Well, one reason is that it's a lot easier to take, excuse me, it's a lot easier to take ammonia and ship it around the world, or even from any point A to point B, than it is to take natural gas and do that, right? So ammonia has real potential as something similar to oil that can be moved fairly simply around the world, but has the property of potentially being a carbon neutral fuel in the future. So for those of you who are sort of farmers out there, this is, I think, a concern in the long run, that ammonia, the same ammonia you use to put on your farm fields, has a different competition in the future for it, which is that it can potentially be another type of input for a renewable fuel. All right, so this is an interesting thing that's sort of coming down the road and should put some long-term pressures on the natural gas market, essentially. All right, let's turn to renewables. Renewables are growing nationally. Here's a picture on the right-hand side since the 1770s, and you can see big increase in sort of renewables in the last couple of decades. Nuclear is a big chunk of that in the last decade or so, but in the last 50 years, but in the last decade, the big increase has been in wind and solar, etc. All right, so it's also growing in Ohio. 4% of our electricity in 2021 was produced with renewables. Estimates from 2022, which aren't fully available yet, appear put that in the range of 7% potentially. It's mostly wind in Ohio, but there's an increasing amount of solar. You can see on the right-hand side, Ohio's electricity generation, and it has a little bit. You can see up here, if you look at the sort of top end of that, you can see the renewables, the yellowest part. So it's small in comparison to everything else, but it's growing. And projections for 10 to 12% in the next decade. All right. So where are we seeing the big increases in renewables in Ohio? Here's a map that I got from Morning Ag Clips a couple months ago that shows all of the new solar factories that are intended to be installed. Some of them have been installed, so the green ones are operational. The blue ones are under construction. I guess that's orange ones are pre-construction, and then there's some pending ones that may or may not get built depending on how the local community responds to them. So there's a big chunk and a big number of these are being potentially built on farm fields across the state of Ohio, mostly on the western edge of the state. I just downloaded some numbers this morning on the bottom here from the PJM. That's the electricity market that we're in here in Ohio, which includes many of the states on the eastern part of the US, sort of from Ohio further to the east. So if we look at this 5.3 numbers, our total load this morning as of about 9 o'clock was 89,252 megawatts. And the renewable load was about 10.1% of that. Back in January is about 5.4% of that. So you can see where we're getting a decent number of renewables in this grid, at least in the summertime and in the morning when electricity demand isn't too great, it's not too hot out. We're seeing that renewables can produce up to 10% on this particular part of the grid, whereas in the wintertime, a smaller percentage, and probably later in the summer, also a smaller percentage, especially as we get to those air conditioning loads that are going to come. You know, we see also the big concern about solar and wind is that they're not always available. Again, if we look at this sort of 125 period and we look at the amount of solar on this PJM grid, you can see, you know, it was a lot the day before. As we got into the nighttime hours, obviously none. And then even during this particular day on 125/2023, it wasn't very sunny. And so it was difficult to get much solar out of that. We got a decent amount of wind. So we had a decent amount of wind power happening at the same time on that day. So, you know, one of the big issues with solar and wind, obviously, is whether that power is going to be available for us at any particular time. I often get the question, why renewables on farmland? So I went out and looked at some of the numbers, and this is from all of these. I looked at all of the, the existing green, and this should be the green ones, the blue ones, and the orange ones, and calculated that those solar farms produce about 225 megawatt hours per acre. I valued that energy at $40 per megawatt hour. That's actually a low price. I would expect more like 46 or 45 to $50 per megawatt hour is what that would sell for. And if we look at that, that means the gross returns of that energy production are about 89 or almost $9,000 per acre per year. All right, so at that price, $40 per megawatt hour, it turns out that the costs of producing and installing that are probably higher. They're probably greater than that. They're somewhere around 10,500 plus about 2,000, so around $13,000 per acre. However, there's a production tax credit or an investment tax credit, depending on which one you get, that amounts to about $6,000 per acre. So when you put all that together, the $9,000 per acre, the $13,000 for the cost, the $6,000 for the subsidy, the net benefit is about $2,300 per acre. So you can compare that to the typical farmland value, which is going to be between $200 and $400 per acre per year. So the electricity value on any acre is significantly higher than the non-electricity value, the farming value of that land, right? So this is a significant value for that land. Now it's driven heavily by the subsidy at the moment. Of course, if the prices are higher, if you're getting $60 per megawatt hour, the subsidy, it turns out, is important, but the net benefits will be positive no matter what. There's another component that you can add into this, which is there's a renewable energy credit, right? So the $40 per megawatt hour is just for the electricity, It's not for the renewable part of that electricity. If you then sell off the renewable part, you sell off the renewable energy credit component of that, which can be anywhere priced anywhere from $4.50 to $20 per megawatt hour. That adds another $1,000 to almost $5,000 per acre per year. So the net benefit of solar on farms is about $3,000, $3,400 per acre to nearly $7,000 per acre per year. Interesting question for the average landowner, I would think, is, well, someone who values that commodity of electricity at this level could probably pay a significantly higher rent than the person who values the commodity of corn or soybeans for the same land. So this is why we're seeing so much of this happen on farmland in Ohio, is it's just so much more valuable. Now, farmers aren't getting this full $3,000 to $7,000 per acre per year. They're getting, I'm sure, a significantly smaller amount than that. But it does indicate that this land in electricity production is worth more than this land in agricultural production, at least at today's market values. So an interesting sort of economic analysis sort of explaining why so much of this is happening on farmland. So why else renewables? Well, renewables have this factor that their costs have been going down dramatically. So on the left-hand side, we see the levelized cost of electricity for unsubsidized wind and unsubsidized solar, and those have come down significantly. So the cost of electricity for wind is about $50, $26 to $50 per megawatt hour, and for solar, $30 to $40 per megawatt hour. These are competitive. These are really competitive, especially if we see these natural gas prices as we did up to $10 per million BTUs, which would put natural gas electricity production prices at 60 to 70, maybe even $80 per megawatt hour. So, when you have, the cost of solar and wind falling dramatically over time and being competitive with natural gas, we can see why so many people are sort of demanding this electricity source rather than natural gas and rather than coal as well. And there's also a huge demand for it among these firms. These renewable energy credits, we don't really know what these prices are. I said $4.50 to $20 per megawatt hour. I'm speculating on $20 per megawatt hour. I would guess that some of these companies are willing to pay more than that. And they will be willing to pay more than that in the next few years as some of their carbon neutrality goals start to bite, as they start to actually try to meet some of those carbon neutrality goals and recognize that the only way to do it is to buy these renewable energy. There's competition for those, right? Because so many different companies now have said they want to be carbon neutral. So it's really interesting driver for renewables within the market. So not only is the electricity really valuable on farmland, even though the costs of producing this stuff have gone down dramatically, it's created a real sort of increase in the amount of the demand for renewables out there, but there's also companies trying to become carbon neutral that are really driving this. So this is a long-term demand driver. Okay, regulations are also having an impact in the eastern states, part of the PJM market. States like New Jersey, have these renewable energy credit prices of $200 per megawatt hour. Pennsylvania, $45. The DC area has seen prices at $400. So these are huge prices. Imagine going back here, imagine rather than $4.50 to $20 per megawatt hour, it's $200 per megawatt. Imagine what that does for the value of farmland in terms of producing renewable energy. It's enormous. Okay, so we're seeing big willingness to pay through regulations and through private entities willing to pay for this stuff. And our government's getting in the act, our federal government's getting in the act and providing massive subsidies to help sort of implement this as well. So the drivers for renewable are there. Some of them are just demand driven by consumers. Some of them are regulatory, and some are regulatory / subsidies, right? So lots of things sort of pushing us towards renewables. And it's not surprising when we look at the Energy Information Administration, they look into the future and they say, wow, more than 50% of the capacity expansion. So these are capacity expansions in the US are going to happen in renewables and mainly in solar. Next few years, we'll see some wind still happening, but most of those are going to be in solar. The rest of them are going to be in natural gas, but a big chunk of them are in solar. So, it's not surprising why we see, the Energy Information Administration sort of making such a strong projection for large additions to solar and wind, et cetera, in the future, just given those demand considerations. All right, so if companies want to be carbon neutral, right, they can buy these RECs, but looking back here, we're going to see a lot of natural gas out there. So not all of our electricity is going to come from carbon-free sources like solar or wind. these companies are really going to be searching for lots of alternatives to clean energy in order to become carbon neutral, if that's really what they want to do. And that's where these carbon offsets come into play. So carbon offsets have become these commodities that represent the removal of carbon dioxide from the atmosphere and the storage of it either in the soil or in a tree, right? And so you can think of 1 credit or 1 ton of carbon stored in soils and 1 ton of carbon stored in trees as an offset for the emissions from flying around in planes, or driving around in cars, or producing electricity, et cetera, right? So there's the potential to produce carbon offsets on farmland. We've seen carbon offset prices decline dramatically in the last 20 years and then increase. This is a 2021 price at about $6 per ton. In the last year or so, they've come up to $7 or $8 per ton. And these are for unverified average tons. In other markets, in the California market, we see offsets going for $18 to $20. So these are really stringently regulated tons. So they get a higher price because they're verified through the California system. And that creates a ton that is pretty certain to be a ton that's removed. New Zealand market is similar and has tons that are pretty certain to be tons removed from the atmosphere. The rest of the voluntary market, if you kind of have a gold standard, really good ton that everybody agrees is a ton that has removed carbon from the atmosphere, it could be worth $10 to $15. The average ton is more worth around $7 or $8 per ton. And the reason for that, the reason why there's a discount for some tons is these, I'll come back to that slide, is these questions about additionality, leakage, and permanence. So there's some questions hanging over this carbon market that sort of are still there. They're going to be there for a long time, and they're related to these concepts of additionality and leakage. This is basically a question about the quality of the tons. And given these questions that are out there, and lots of people are asking questions about them, what we're seeing is that if you have a ton that you can ensure is additional, has no leakage, and is going to be quote unquote permanent, it'll be worth $10 to $15 a ton on a voluntary market. If you have a ton that has some question marks about its additionality, its permanence, or its leakage qualities, it's going to be discounted and it's only going to get $6 or $7 per ton. All right, so this is kind of what we're seeing in this market. We're seeing a bifurcation between tons that have this sort of gold standard high value seal on them versus the other tons that are a little more speculative in nature. That's going to continue on. I don't see that changing in the long run. Okay, but this market is set to explode. These are just some projections a student and I put together in terms of looking at what is likely to be the demand for offsets in the next 30 to 40 years. So we looked at sort of McKinsey, the Intergovernmental Panel on Climate Change, Morgan Stanley, a company called BCG, Bloomberg, et cetera. All these companies gone out and made projections of where this market is likely to go. And they're seeing estimated demand for tons anywhere from 2 gigatons or billion tons in 2050 up to 13 billion tons. That would be enormous. Let me say that in the US, if we actually got to 13 billion tons of carbon dioxide, it would be a bonanza for landowners. Land value would not only be worth a lot in renewable energy production, but it would be worth an enormous amount in growing trees in order to keep that carbon out of the atmosphere. So there's going to be a huge competition for land in the future if demand really gets up to this level. That is, unless we can figure out some other ways to either produce renewable energy or store carbon away from the atmosphere without growing trees. All right, so lots going on there. So in conclusion, oil is going to be around for a while. Prices are probably going to hold steady as competition between electric and internal combustion engines heats up. That's going to be a good thing. It's going to give us some freedom from OPEC, and it's probably going to keep oil prices down and keep us from engaging in some of those really complicated and difficult projects, say in Alaska and in the Arctic, et cetera, et cetera. Natural gas fertilizer prices are probably going to continue to soften, but we are going to see competition for fertilizer in the future as more and more fertilizer is demanded for, I should say ammonia is demanded for its hydrogen rather than for its fertilizing properties. Renewable energy is going to continue coming online, and that ultimately does put a ceiling on natural gas prices. That's going to take a little while to emerge. This carbon offset market is starting to really grow, and I suspect that within the next 5 to 10 years, we could see prices about 100% higher, or doubling over the next 5 to 10 years. Okay, wanted to jump on to questions. I got some great questions from folks who, when they signed up, sent these questions along. So I just wanted to answer a couple of those really quickly from people. I didn't touch on renewable diesel. I should have, and I probably will next time. This is a really interesting thing. So there's important to keep a difference between renewable diesel and biodiesel. Renewable diesel is diesel made from vegetable oils, which is refined to be substitutable and blendable in every way with traditional petroleum diesel. Okay, so it's a complete sort of, you can shift between the two in your truck, or you can put 50% of one and 50% of the other in the truck, and the truck should run the same no matter what. All right, so renewable diesel is the growing part of the market. Biodiesel is sort of vegetable oils, recycled oils, et cetera, used to produce diesel. That stuff is not substitutable exactly for renewable diesel. It can be used in diesel engines, but you probably shouldn't mix it together with renewable diesel. All right, so it's not quite the same, although it can be used in many of the same engines. All right. So what we saw originally is a massive increase in this biodiesel market, and that's up here on the upper left-hand side. You can see sort of the growth in that market between 2000 and the present. More recently, and massively growing in the last 3 to 5 years, is this renewable diesel market. So this renewable diesel market is starting to explode, and given capacity expansion, given the amount of money that refiners and refining companies are putting into creating a refinery capacity to produce renewable diesel, mainly from soybeans, has grown. All right, so we've gotten a massive increase in capacity, and that's set to grow. There's a number of plants set to open in the next 3 to 5 years. So this is really good. The only thing I can equilibrate this with is what happened with corn demand when we had the big expansion in ethanol in the early 2000s, right? That's going to happen with soybeans, in my estimation, in the next 5 to 10 to 15 years, because we're going to see far more renewable diesel sort of entering into the market. And one driver for this is a low carbon fuel standard in California, as well as the US renewable fuel standard. So, but another driver for it is that this is renewable, right? It doesn't emit net carbon dioxide. Its net carbon dioxide emissions are far lower than traditional diesel. And this is what companies are demanding. So, if Amazon can move around its stuff in these big trucks on renewable diesel, then it's producing a lot less carbon for the atmosphere than it would be producing with traditional petroleum diesel. So there's going to be a high demand for this renewable diesel going into the future for environmental reasons. All right, so that's one. So the question on renewable diesel, it's a fantastic market. It's emerging, it's growing, it's going to continue to grow. Another question someone asked is, do we have the energy infrastructure to meet the demands for electric vehicles? We don't right now, right? We just don't, but we will. We'll build it. And the private investment required to accomplish this is going to be extraordinary. So we're going to see massive transitions in the future to meet the demands for electric vehicles if they expand as much as people are sort of expecting them to expand. And this is just a picture of the history. Another question is, what sources of energy are we going to be using 10 to 50 years down the road? Kind of follows with that last question, right? Is that what's going to happen in the future? Well, look to the past, right? 1775 to the present. Look at these amazing energy transitions and these phenomenal changes that happened over these relatively short 20 to 30 year periods. And imagine that happening for this green line, right? Imagine that happening, I should say, for, no, they don't have actual, this is nuclear, but imagine this happening. They don't have renewable on here as well as they should from the EIA. But imagine the same thing happening, this big increase in petroleum that happened between 1900 and 1950, 1960. Imagine that happening over the next 30 to 40 years for renewable energy, right? It's not so hard to imagine, really, that we could have really quick adoption of this new technology for electricity production in the US, given what we've seen in the past, right? So this is my guess, is that energy sources are going to switch to sort of put the 10-year one. So we showed this slide earlier, US energy consumption in proportion in 2021. So I sort of put my projections here in red next to that for 10 years and for 50 years. And I sort of suspect that in 50 years, our renewable component is going to be about 60%, oil down to about 20%, natural gas 9%. We're still going to have some coal, I think, for a fuel that we have to have from time to time. Nuclear energy is going to see a bit of a rebound, I think, in the next 50 years, right? So that's probably where we're going to go. That's probably in line with a lot of other projections as well. Another question was, do oil and natural gas pull poor countries out of poverty? You could ask the same question about poor counties in Ohio or West Virginia, et cetera. The interesting thing is we don't have any evidence that oil and natural gas pull poor countries out of poverty. Most countries that are rich in resources for oil and natural gas have relatively low income per capita, and even as price changes and prices increase for oil and natural gas, we don't see big increases in income per capita in those countries. So they seem to do a really poor job of distributing that income. Another way to think about that is that countries that seem to have the highest income per capita do so by creating new technologies that are really efficient at using oil and gas rather than using just more of it. So they gain from making efficiencies out of that and creating other kinds of products that are sort of derived from energy consumption, but not necessarily just related to energy production. So there is a big disconnect between sort of countries that have lots of natural gas and oil and their income per capita. And you just think of the country, Saudi Arabia, their income per capita is less than half the US's. Russia, less than half the US's. Venezuela, less than 20% of the US's. So, Canada is the one exception that has the world's largest oil reserves, and they have pretty high income per capita, yet they don't produce a lot of those oil reserves. They're actually far lower in terms of producing oil and natural gas than most other countries. So even though they have the resource, they're not using it as significantly as they could. So it's an interesting question, but I don't see that natural gas or oil reserves really help a country become more richer over time. How to include, so an interesting question about how to include costs for storing radioactive waste. I have to leave that for the future, but is an interesting question if we go down the road of nuclear energy. My theory is that we've already got a number of locations that are already devoted to creating nuclear energy, and probably that's where we're going to keep the radioactive waste for a long time to come, because I don't see a lot of motivation amongst people to move it from one place to another. But that's just a personal opinion, not a really deep analysis of that particular question. Then another question about why does local margin for diesel vary so much? Diesel is an interesting thing. It really does. It's inelastically supplied and demanded. But the reason why the local margins really vary so much is because of transportation. There are fewer refineries that produce diesel than there are refineries that produce other kinds of products. So diesel often has to be transported a bit further. The second part of that is that local demand is really important because of its importance for the transportation sector. So those local demand factors also have a big effect on sort of the basis for diesel prices. So I'll leave it there. Those are the only questions I got online. Ian, I don't know if there are other questions that folks threw out there.
Actually, there was a question that would the slides be available, and I put in the chat room that they would be. So I'm assuming that we put the slides up along with the recording of your talk. We have one question from Amanda Harris Silvers. Is the LNG the same as propane? If not, what is the role of propane in overall energy production?
Yeah, no, LNG and propane are not the same. I mean, propane is can be natural gas. Of course, LNG is just liquefied natural gas. So that's it's basically take natural gas and make it really, really cold. So it becomes liquefied, and then it can be put into a big tanker and shipped around the world in a huge sort of super tanker. Propane, is mainly in a gas form and is used mainly for combustion. Obviously, we use it for, cooking in our homes and doing other kinds of things like that. So the key difference is just the liquefied part, which takes a lot of energy to do. And it's one of the things that increases the cost of moving natural gas from one continent to another. If you have a pipeline in place, you can move natural gas pretty easily from place to place. Of course, it's capital intensive to do that. But you can't put pipelines across oceans typically. You can, but over long oceans or really big oceans, like from the US to Europe, it'd be really difficult and expensive to put a natural gas pipeline in. So what we've done is we liquefy it, we stick it into a super tanker and send it over to those other countries.
If you have any more questions, please put them in the Q&A box or in the chat. We have about 5 minutes left for our webinar today. I had a couple of questions for you, Brent. First of all, what are the prospects in the Farm Bill for related to renewables? What are you seeing there in the Farm Bill? I think I've heard you talking about that fairly recently. And so if you want to answer that question, I have another question I can follow up with.
Yeah, I haven't actually paid attention to how the Farm Bill is affecting renewable fuels. I'm going to imagine they're going to continue with some of the credits that are available for people who produce biomass, especially for sort of the renewable fuel standard. I mean, the big argument obviously is, what and how are the renewable fuel standards set by EPA on an annual basis, right? As we continue to try to push towards this, an increasing amount of cellulosic stuff, an increasing amount of renewable diesel, et cetera, et cetera. But I think what's happening in that is that the demand side on renewable diesel is being driven by so many other factors than government factors that's going to drive that market more so than the Farm Bill will. I mean, if you read about the number of new refineries that are being put in to create and produce renewable diesel, you're seeing over the next 5 to 10 years will probably be a huge increase in the quantity of renewable diesel that's produced. And as long as soybean prices don't get too high, and this is going to be an interesting question, right? The issue is that if we're going to be producing a massive amount of renewable diesel. So let me step back a bit and say that I'm going to guess that there's going to be enormous pressure from the energy sector, a different sector, for the U.S. to have a strong farm bill, because I'm going to guess that the energy sector, that is the traditional diesel and oil sector, the refining sector, is going to want to get soybeans produced in the U.S. at a relatively modest price. So I think there's going to be an increasing pressure from the energy sector on a farm bill that delivers high levels of soybeans for an emerging market to produce not just feed for cattle, but also feed for renewable diesel. So I think it's going to create an incentive for Congress to ensure that whatever they do, that there are plenty of subsidies to produce soybeans as well as corn.
Well, the US farmer, instead of selling soybeans to China, will let the Brazilians do that, and we'll sell farmers will sell soybeans to Marathon or whoever in the energy sector. That's an interesting.
It's such a growing, and when you look at the number of the capacity expansions for refineries that can handle that, it's huge.
Hopefully this will come up in our farm science review discussion of the farm bill, and maybe the one we have at our outlook and policy meeting in November. My other question, this draws on your students' little thesis the other day that I attended, and it's about, I guess it's a geopolitical question. If I remember from the students' presentation, the Chinese have a dominant market share in terms of accessing the necessary resources for lithium batteries, particularly in a country like the Democratic Republic of Congo. In terms of electric vehicle expansion, particularly here and maybe in the United States and Europe relative to China, do you worry about that sort of the almost monopoly that China has over those supplies of the raw materials?
Yeah, I think it's a legitimate concern. I think the U.S. has to be really careful on that from a geopolitical standpoint. I think even another big thing, if you read the news, where Chile has nationalized their lithium reserves. So cobalt and lithium are two really important commodities that are used to produce these batteries. And there's a lot more lithium in Latin America. I mean, there's lithium, I think the biggest lithium supplies are in Africa, but there's a lot of it in Latin America as well. So I think there's an emerging concern. I think it's something the U.S. is going to have to keep track of and spend a lot of time trying to figure out. And that's obviously not just a market thing, but I think that's a geopolitical thing that things like the State Department. I mean, we saw with the vice president taking a trip to Africa that it seemed to be mostly revolving around setting up the opportunities for American companies to be able to go and extract lithium and cobalt. So I think there's a lot more emphasis on that now, and it is identified as a critical resource.
Okay, I don't see any more questions in the Q&A or the chat, so I think we'll finish up there. But Brent, I think you were just going to put up a slide very quickly for our next webinar.
Yep, I'm going to just let everybody know that we have another webinar coming up, and I'm going to share the screen here. So the next webinar is Margaret Jodlowski. Hopefully you guys can all see that. She'll be talking about the Farm Bill and sort of where the Farm Bill's at. And that is going to be on May 31st from noon to 1. So hope everybody can join us for that one.
Okay, great, Brent. I'd like to thank you very much for presenting today. As always, lots of detail and with your take on where we're going with energy markets. I'd like to thank everybody who participated today, especially if you put a question up front to Brent. So we had a really nice structured question and answer session there that didn't rely on the Q&A box in the Zoom. So appreciate it, Brent. Thanks for people for attending, and we hope you can make the next webinar at the end of this month. So thanks very much. Goodbye, everybody.
Great. Thanks, Ian.